Hello everyone. During the past two classes, we were discussing the chapter cash flow statement in accountancy. There we have discussed so far what is a cash flow statement, what are the utilities or usefulness of cash flow statement, what are the benefits of cash flow statement, and discuss the limitations of cash flow statement, and also discuss the format of a cash flow statement as per accounting standard 3 revised, and told that we will prepare the cash flow statement in indirect method. And in the last class we have solved a question related to preparation of cash flow statement. In that question we have seen how we can take depreciation and how to find out the sale and purchase of fixed assets, etc. in that question. Today we are going to solve another question where we will be studying how to treat provision for tax and how to take interest on borrowings without preparing an account, etc. will be discussed today. So here is the question. Following is the balance sheet of ABC Limited. You are required to prepare cash flow statement. Share capital is given and their notes to account is there. So it's not we will be seeing, and reserves and surplus is there. Then non-current liabilities are there. After non-current liabilities, in non-current liability itself, long-term borrowings is there, that is specifically given 15% debentures. Then short-term borrowings, that also specifically given, that bank overdraft. So bank overdraft is directly given, so no need of, it is not given that notes to account and all. Then short-term provisions are given, their notes to account is given. And below that you can see various assets, non-current assets are there, fixed assets, net value is given, that means after deducting depreciation its note to account is given, we will see that. Then current assets and cash equivalent also is given. So here notes to accounts also there for various things, and additional information is given here. Interest paid on debentures rupees 18,000. Preference shares were issued on 31st March 2020, and tax provided during the year was 1 lakh. Tax provided during the year means tax written off from the profit and loss account. Provided means it is deducted from profit. It does not mean that tax paid. Tax paid is not given, but is given tax provided, tax written off from the profit and loss account is given. Okay. Now let us solve the question. So for that we are going to prepare a cash flow statement. Cash flow statement is here. We are going to see that in the books of ABC Limited. Format of cash flow statement is ready. So first of all we have to write cash flow from operating activities. In that cash flow from operating activities we need to write net profit before tax and extraordinary items. So net profit before tax and extraordinary items we have to calculate. We have studied the format for calculating net profit before tax and extraordinary item. So let us write that here, working notes. In that working note 1, calculation of net profit before tax and extraordinary items. So here we have to write the particulars and amounts. So heading is given. Now what we have to see, we have to write the profit for the closing date. Closing date profit is given here 2020, here 2020 profit surplus, balance in statement of profit and loss. This is statement of profit and loss is written. So that we can write first. net profit at the end of the year, how much? 24,000. So that 24,000 we are writing. Then from that, opening balance will be deducted. 20,000 is the opening balance, that will be deducted. Less net profit at the beginning of the year. 20,000 is deducted. So we will be getting 4,000 as the opening balance. Sorry, that current year's profit will be 4,000 rupees. That we will write here. So that is what is net profit for the current year. Then along with that, what are the appropriations of profit that will be made? What are the expenses appropriated to profit that will be taken here? See here, along with the profit, there is general reserve. Last year 40,000 was there. This column is for the previous year 2019 and this is for the current year 2020. So last year general reserve was there 40,000. Now it is 50. It became 50,000. That means this year how much is transferred to general reserve? Yes. How much? 10,000 is transferred. So that we will be writing here, add general reserve 10,000. Next item is tax made during the year is given, isn't it? Tax made during the year is given. Tax made during the year is 1,000. That means tax made is to be written. That means tax made, I have told that tax made is the amount of tax written off from the profit. So 1,10,000. Then out of this 1,10,000, that is the total amount to be added to profit. So now we will get 1,14,000. That is the profit before tax and extraordinary items. Okay, so this can be taken to the cash flow from operating activities as the first item, net profit before tax and extraordinary items. Okay, 1,14,000. This working note is shown here. That is what we have done there. Next, along with this, we have to add all non-cash, non-operating expenses. Non-cash, non-operating expenses should be added. First of all, let us write. Last class also we have seen depreciation will be written, goodwill written off if it is there, that will be written. So let us see depreciation in the question here. Depreciation is there. So current year depreciation account balance, provision for depreciation account balance, now it has 3 lakh. Last year 2,20,000. So how much is transferred this year? Yes, 80,000 is transferred. That we have to write. Depreciation 3 lakh minus 2,20,000. How much? 80,000 will be written. Next, after that, another non-operating expense, interest on debentures. Interest on debentures. So debenture, here on adjustment is there, interest paid on debentures 18,000. Interest paid is 18,000. So otherwise also we will get that amount here, because debenture 15% debenture, 15% of the opening balance. That means last year interest will be given this year. So 1,20,000 into 15% will get 18,000. Otherwise also that amount is directly given. So you can write here 18,000. Now the total is 98,000. 98,000 can be added to 1,14,000. So we will be getting 2,12,000. But it is operating profit before working capital changes. So you know that format. In the last class we have told that at least 3-4 times you have to write and practice the cash flow statement format. then only all the items will be retained in your mind. Okay, so what is to be done next? Next we will add all decrease in current asset and increase in current liabilities. So decrease in current asset and increase in current liability should be added. So let us see current assets. Inventory. Any decrease is there? Inventory decreased 1 lakh compared to last year. From last year 1 lakh is increased. Here trade receivables also increased. Cash of course we will not take now. So there is no decrease in current assets. Then let us see current liability. Any increase is there? Current liability, here bank overdraft will not be taken, it will be considered as short-term borrowings. So current liability, trade payable, it has decreased. So current liability also decreased. So there is no decrease in current asset and increase in current liability. So nothing is there to add, but we have things to deduct. That means increase in current assets and decrease in current liabilities are there to deduct. So we have seen inventory from 6 lakh to 7 lakh. Inventory is increased. So we can write inventory increase 1 lakh. And next trade receivables. 80,000 is increased. So let us write that also. Trade receivables 80,000 increased. Now assets over. Let us see liabilities. What is to be written? Decrease in current liabilities. Yes, trade payable decreased. 20,000 decreased. So that 20,000 will be written. Okay, so total 2 lakh will be transferred to outer column. So from 2 lakh 12,000 we have to deduct 2 lakh, then we'll get 12,000 rupees. What is that? That is cash generated from operations. Okay. Now from this we have to deduct income tax paid. Tax paid is to be deducted. Is it given here anywhere tax paid? No, not at all given. It is not directly given. So we have to find it out, because where tax related information is given. See here we can see short term provisions. Note number 3. Let us come to note number 3. What is given here? Short term provisions. Provision for tax. Last year 1,60,000 and this year 2 lakh. So let us see how to treat provision for tax. For that we will see another working note. This is format of provision for tax account. This is very important. Should not forget this. So this is the format of provision for taxation account or provision for tax account. Since it is a liability account, we have to write first the opening balance. Opening balance we have to write. Okay. So if in the question if nothing is given as tax paid or tax made, tax paid means tax given to government. It is if it is not given, like that tax made during the year is not given, or tax provided during the year is not given. That means tax written off is not given. What we have to assume is that opening balance is paid. That is what we have to assume, because it is the amount to be paid to government. So what is the outstanding amount that should be paid immediately? So if nothing is paid, we will see that that same amount is paid. So since it is paid, we will write to bank. Okay, the same amount will be shown as paid. Then tax made or tax made means tax provided or tax written off from the profit. If it is given, that we have to write in the credit side. Okay. And of course we know that the closing balance will be shown on the debit side because it's a liability account, and opening balance is shown on the credit side. So we have to show closing balance in the debit side. Okay. This is the format. This is the format of provision for tax account. Now let us see. Here you have to see that some numbers are written. This numbers showing some notes. We are going to see that. What are the notes given to that? This is also a very important thing. Okay. So what first point says, that means tax paid. Tax paid means if tax paid is not given in the additional information, tax paid if not given, opening balance of provision for tax is to be treated as tax given to government. Okay. Then if provision for tax made during the year is given, made during the year means provided during the year. Here it is given 1 lakh, no, like that. If that amount is given, tax paid will be the balancing figure. How it will be the balancing figure? Suppose here opening balance is given, closing balance also given, that will be there in the balance sheet. Then tax made during the year or written off is given here. So what we will do? We will add all this column and this column will be deducted. Then we will get the answer here. So that will be the balancing figure. When it will be the balancing figure? When tax made or tax written off from the profit is given. Then if it is given, tax paid will be the balancing figure. If tax paid and tax made both are not given, we will assume that opening balance is paid. Okay, and opening balance is paid and the closing balance is the balance made during the year. Okay, so that's what the treatment for tax paid and made. So tax paid should be deducted from cash generated from operating activities. Tax paid should be deducted from cash generated from operating activities. This should not forget. And another point says that point 2, you can see in the credit side of the account, provision for tax made during the year should be added. This is provision for tax made during the year or provided during the year. It should be added for calculating profit before tax and extraordinary item. Okay, so that is what we have done here. Tax made during the year 1 lakh, tax provided is written here. Okay, now let us see the account as per the given question. So that we can write working note 2, provision for tax account. So this is the format. See, what is the first item? Opening balance of provision for tax. Opening balance 1,60,000, closing balance 2 lakh. So let us write that first. Opening balance brought down 1,60,000 and closing balance. Closing balance is balance carried down 2 lakh. Okay, so these are the items given, and we have given here tax made during the year 1 lakh is given. See, 1 lakh is given. So tax made during the year we can write as by statement of profit and loss. That is the tax written off during the year. So 1 lakh rupees. Okay. So since this is given, since tax made is given, we will get tax paid as the balancing figure. So here 2,60,000 is transferring to the debit side and will deduct from 2 lakh, and 60,000 is the tax paid during the year. Okay, so tax paid during the year is given 60,000. Clear? So with this amount, this is the amount of tax paid, and tax made during the year is adjusting to profit and loss account. That's what we have taken for calculating profit. So this 1 lakh is already taken. Now let us see how to take 60,000. 60,000 we have already told that it will be deducted from cash generated from operating activities, isn't it? So 60,000 is deducted from 12,000. Therefore, we will be getting a minus figure of 48,000 rupees. That is cash used in operating activities. Cash used in operating activities. Okay. So that is what related to cash flow from operating activities. Now next point, let us see. Second point is cash flow from investing activities. Cash flow from investing activities. That means we know that investing activities include all the activities related to purchase or sale of fixed assets. So here related to fixed assets, what we have, that's what we are going to see. See, fixed assets, gross value or cost value is given. That means purchase price of the asset. Opening balance 8,20,000. Now it became 8 lakh. Why it became like that? That's what we are going to see. Opening up to last year, depreciation written off was 2,20,000. Now it became 3 lakh. So how much is the increase in depreciation? Yes, 80,000 is the decrease. So due to that, so now 8,20,000 minus 2,20,000, we have got 6 lakh, and now at present what we have, 5 lakh is there, isn't it? So if you deduct depreciation, 2,20,000, 6 lakh should be there, but from this 6 lakh was the closing opening balance last year, but this year ending it became 8 lakh, and when we deduct the depreciation it is coming 5 lakh. So from 6 lakh, if you deduct 3 lakh, we have to get 3 lakh only, but 2 lakh has increased. How it is increased? How the fixed asset increases? Fixed asset increases by purchase of fixed assets. Okay. So let us see whether it is actually purchase or sales. So anyway, we can write cash flow from investing activities. In that, before writing that, let us see depreciation, how much we have taken, 80,000. How we have taken? Closing balance of provision for depreciation account was 3 lakh, opening balance was 2,20,000. That means this year created depreciation is the difference, 80,000. So that we can calculate with the help of working note also. See, working note 3 we can make. Here we have a provision for depreciation account. So if question comes like this, you can follow the same way. You can write the opening balance of provision for depreciation account, it is 2,20,000, and the closing balance is 3 lakh. Okay, that two things are written. So we can close that account. 3 lakh will be transferred to credit side. 3 lakh minus 2,20,000, that is the difference, 80,000. What is this? Opening balance was 2,20,000 only, closing balance became 3 lakh. So that is because of depreciation created during the year. Depreciation is created for the tangible asset, so we can write here by tangible assets. That means the depreciation charged during the current year. Okay, depreciation charged during the current year, that is the balancing figure of the account. Now let us see how to take that in the asset account, that means tangible asset account. We have here tangible asset account. So it's an asset account. So let us write the opening balance on the debit side. To balance brought down, we know that what is the balance brought down. Let us take the net value. 6 lakh is the balance brought down. Opening balance 6 lakh. 6 lakh was the opening balance. And the closing balance we know it is 5 lakh. Okay. And depreciation is the decrease in the assets, so it will be credited. Depreciation how much? 80,000 is credited. See, opening balance 6 lakh was there. After deducting depreciation 80,000, actually it should be 5,20,000 balance, but now it became 5 lakh. So we can balance it now. 6 lakh minus 5 lakh 80,000. The balance we can write inside, that is 20,000. Other than depreciation, how the asset will decrease? That may be due to sale of an asset, isn't it? So that's why it has decreased here in the credit side. So if balance you get in the debit side, it will be purchase. If you get the balance in the credit side, other than depreciation, it will be sales. In your last problem, you can refer. In that fixed asset account we have prepared, plant account we have prepared. In that plant account we have got a debit balance, so that we have taken as purchase. Here the balance is in the credit side, that means we have sold tangible assets for rupees 20,000. So that's what we have to write here. Proceeds from the sale of fixed assets. Actually it is tangible asset, we can write tangible asset. How much? 20,000. Okay, then so 20,000 we will write, that is the only item in the investing activity, so that 20,000 can be written down. Against that we can write that is cash flow from investing activities. Now the third activity, cash flow from financing activities. This is the activity related to the financing area of the business, that means issue and redemption of shares, debentures, payment of interest, dividend, etc. So here we can write first, before writing here we can write, see the position of the capital. See, equity capital last year, equity shares 8 lakh was there, now it became 9 lakh, isn't it? That means equity shares issued, so we can write proceeds from the issue of equity shares 1 lakh. Like that, preference share last year nothing was there, this year 1 lakh came, so we can write that also. Proceeds from issue of 12% preference shares, amount 1 lakh. Okay, then after that financing item, next let us see long-term borrowings. Long-term borrowings, we have debenture last year 1,20,000, now it became 1,30,000. That means 10,000 debentures also issued. So proceed from issue of 15% debentures 10,000. Okay, then In the adjustment it is given that interest paid on debentures 18,000. That also we have to take interest paid on debentures. How much? 18,000. It is payment, so it can be written in brackets. And you can see one thing. It is 12% preference shares. So 12% dividend also we have to take. But the thing is that in the adjustment it is given that preference shares were issued on 31st March 2020. The last date only it is issued. That means it was not there in the beginning years. So since the amount was not there for the beginning year, last year, we need not pay dividend. Okay. In the same way, in the case of this debentures or preference shares, whatever it is, if interest payment or dividend payment is not directly given, and if percentage is given, like here 15%, you have to calculate the interest on the opening balance, not on the closing balance. Opening balance into that 15%. But here in this case of debenture, it is directly given, so no need to take that one. Okay. Then next, another financing item is, here it is given short-term borrowing, but it is bank overdraft. Bank overdraft, last year 2,50,000 was there, this year it became 1,36,000. That means some of the bank overdraft was paid back. So decrease in bank overdraft, 1,14,000 should be taken. Okay. Now financing activity over, we can see we can add all the plus item, from that all the total of minus item can be deducted. We will be getting 78,000. So this 78,000 is the cash used in financing activities. Cash used in financing activities. Then all the three activities are over. So financing activities over, then investing activities over, cash flow from operating activities also over, that is cash used. So we have to add 78,000 and 20,000, and from that 48,000 is to be deducted. What is that? That stands for net increase or decrease in cash and cash equivalent. How much? 50,000. So what is the next? Yes, we have to add cash and cash equivalent at the beginning of the year. That is 30,000. So we have to get cash and cash equivalent at the end of the year. See, cash and cash equivalent, you can get cash and cash equivalent, opening balance 30,000 was there, that is taken. So we have to get 80,000 as the answer. That is the closing balance of cash and cash equivalent. Cash and cash equivalent at the end of the year is 80,000. So since we are getting the total of net increase and decrease in cash and cash equivalent and cash and cash equivalent at the beginning of the year equal to cash and cash equivalent at the end of the year, the problem is correct. Okay. So this is the way of solving a question related to cash flow statement. Okay. Here you can see the cash flow statement. So what are the important things we have studied here? Here we have seen how to calculate net profit before tax and extraordinary items. That is one important thing. And another one is how to make that format of provision for tax account. Okay, this should not forget. This you can pause this video and can write these notes. And after that we have seen how to adjust provision for tax in its account in the actual example. And after that we have seen how to prepare provision for depreciation account and related asset account. Okay, so these are the most important things we have seen here. So same type of problem you can find from reference books and can solve, and need not hesitate for asking any doubt regarding this. I hope all of you understood this. So this is the question we have. Based on this question only we have prepared. So you can write down this question by pausing the video, and after that you can try to solve it, and after solving again you can look the video to see the answer, and after that if there is any correction you can make it. Okay, so I hope it is very clear to you. Okay, thank you very much.